The strangest financial lesson I ever learned started with a steak dinner I couldn't afford. Maybe you know the feeling. You do everything right. Work hard, save, invest every single month. And somehow you still feel like the only idiot in the room still playing the slow game. Here's something strange. In a hospital, when the EKG monitor goes flat, when that line stops jumping and turns into one smooth, straight beam, that means death. But in the financial world, right now, countless people are chasing that exact same flat line. Zero volatility, no ups, no downs, no ugly red days, no stomach drops, no should I sell panic, just a perfect smooth curve going up, up, up. We're so afraid of the stock market's roller coaster that when someone hands us a private, professionally managed, steady income mystery box, we want to believe it is safe. But here's the part most investors only learn too late. The financial world obeys one law, and it almost never breaks it. Risk does not disappear. If there is no volatility on the screen, then the volatility has usually been pushed somewhere else, into the fine print, into the exit door. At one moment, you actually need your money back. What I found out later changed how I think about guaranteed anything. It started on a Tuesday, 6 p.m. I'm sitting in my 7-year-old Honda Civic, paid off years ago. The AC still smells like mildew. I'm 32. I live in Atlanta, where the cost of living just keeps climbing no matter what. I work a standard middle management job at a traditional supply chain company, about $75,000 a year. After rent, health insurance, car insurance, groceries, and the random bills that somehow appear every month, I have to be disciplined just to squeeze out $500, maybe $800, to auto-invest into SPY, the S&P 500 ETF, through my Vanguard account. Today, the market dropped 2%. Not a crash, not a disaster, just one of those ordinary red days that still makes your stomach tighten when you are not rich enough to call volatility opportunity. I'm standing in the grocery store, mentally recalculating next month's budget, and yes, I hesitate before buying a steak. My college roommate Dave, also 32. He's on a completely different track. Enterprise sales, red-hot SaaS company, base salary plus commission, pulling in close to $200,000 a year. He drives a brand new Tesla Model 3, leased, spotless, always clean. And because he rode the tech stock wave the past couple of years, he's sitting on $150,000 to $200,000 in idle cash. One night, he posts a picture, white tablecloth, dim lighting, a wine glass tilted just enough to look effortless. Turns out, he just qualified for something exclusive, a Wall Street Insider private real estate fund. $100,000 minimum buy-in. And this fund pays out 8% annualized, right on time, every single month. His account growth curve drawn straighter than a ruler. No daily volatility, no public market drawdowns, monthly income. Sounds perfect, right? But if you know anything about supply chains, anything about systems engineering, your radar should already be going off, because any system that claims zero friction is not frictionless. It is just hiding the friction somewhere you're not looking. We just didn't know where the black hole was yet. I found the black hole at a backyard barbecue. The pressure doesn't come from someone pointing at you and calling you poor. It's just in the air. It is more subtle than that. It is just in the air, everywhere. Weekend gathering, Dave's backyard. He's flipping premium tomahawk steaks on a $2,000 Traeger grill. Everyone's casually chatting about inflation, about investments, and I'm standing off to the side, holding a warm, budget Miller Lite from the discount supermarket. Then Dave's Apple Watch buzzes. He glances down. A relaxed smile spreads across his face. He pulls out his iPhone from his Lululemon shorts. Someone nearby jokes, "Good news?" Dave just shrugs. He passes the screen around for everyone to see. "Nothing," he says, in this impossibly calm voice. "Just the monthly distribution from that private fund. This thing runs like clockwork. When the phone gets to me, I see it, and it breaks something inside me. It's not the jagged, heart attack-inducing red and green candlesticks I'm used to seeing on Robinhood, on Vanguard. No, it's a perfectly smooth, upward-sloping green line, like it was drawn with a ruler. And right in the middle of the screen, monthly distribution cleared, $1,330. Dave slices the steak, looks at me with this genuine, almost caring concern. "Bro, you really need to stop letting the public market jerk you around. That path is exhausting. I can hook you up with my account manager. You need to let your money do the heavy lifting." Nobody laughed at me. Nobody said a word. But that casual concern in Dave's eyes, combined with "let your money do the heavy lifting," combined with that flawless, ripple-free curve, it hit my chest like a straight punch. That feeling, everyone around you making money the smart way, while you're still grinding and calling it discipline, is more suffocating than any direct insult. So stop for a second. Picture it. You're standing next to that $2,000 grill, watching numbers land in someone's account perfectly every single month. Could you withstand that feeling? Someone your age is earning more in monthly distributions than you managed to invest that entire month. His money looks calm, your money looks chaotic. At that exact moment, my defenses started to crack. My defenses didn't hold past midnight. That night, I fell apart. I sat there, staring at the small, jumpy numbers in my own account. SPY was down, my contributions looked tiny, and the ugly question came up. Then, quietly, almost without deciding to, I clicked the fund link Dave had dropped in our group chat. The landing page was beautiful, not flashy. That would have been easier to resist. It was worse than flashy. It was tasty. Private commercial real estate credit, monthly income, experienced institutional managers, reduced exposure to public market volatility, $100,000 minimum investment. Those words were seductive, poisonous, but seductive. Not because they promised to make me rich overnight, because they promised something even more dangerous. They promised I could stop feeling poor. My finger hovered over invest now. I wanted the monthly payment. I wanted that same effortless confidence Dave had in a city that never stopped squeezing you. And in that moment, I thought, what the hell is delayed gratification really? Is it wisdom, or is it just a story people tell themselves when they cannot access the better table? So much for not numbing myself. I clicked it, invest now. But the screen didn't take me to a payment page. Instead, a cold disclaimer popped up, forced me to check a box. I confirm I am an accredited investor. A small question mark icon explained it. In simple terms, under SEIC rules, you generally need high annual income or a net worth over $1 million, excluding your primary residence. In that instant, the pop-up acted like a nightclub bouncer. Cold, direct. Dave can enter. You're not worthy. At first, I felt rejected. Then I felt angry. We assume thresholds like this exist because the rich are being invited into better opportunities. And maybe sometimes they are. But that night, a darker thought hit me. Maybe the threshold is not only about giving rich people access. Maybe it is also about saying you are wealthy enough to lose money without the system needing to protect you. I want to be clear. That was my interpretation in that moment, not legal advice, and not some grand conspiracy claim. I'm not a regulator. But once that question entered my head, I could not unthink it. My ego was stung badly. I didn't close the page. Instead, out of resentment, out of a stubborn need to see what kind of magic this really was, I scrolled to the bottom, to the gray area nobody clicks, the full prospectus, the PDF nobody ever reads. Because here's the thing, I work in supply chain, and my professional instinct kicked in immediately. When a system looks too smooth, find the bottleneck. If it is an asset somewhere, there is a trade-off. So I downloaded the 200-plus page document, hit Control+F, searched 2 words, liquidity and withdrawal. The pages jumped, fast, until they stopped. On page 187, a dense block of tiny unbolded text. I read it, word by word, and cold sweat broke out on my back. Buried in the legal language was the line that changed the whole investment for me. Under certain market conditions, the fund could limit redemptions, and the quarterly redemption cap could be restricted to around 5% of net asset value. I don't know if you've ever read the very last line of fine print on something you signed, but translated into plain English, this sentence means, when the weather's beautiful, you can get off the ride anytime. The second it starts raining, we weld the doors shut. This wasn't zero risk. This was visible volatility being converted into hidden liquidity risk. And honestly, in that moment, I stopped feeling humiliated that I couldn't buy in. I felt like I was staring straight into an elegant mousetrap. That's when I woke up, completely. But waking up didn't save Dave. Eventually, the rate hikes came. The Fed kept raising rates. Commercial real estate sat vacant. Private companies started defaulting. But Dave's account, still a perfectly straight line, climbing, so flawless it was almost frightening. Until one day, Dave found a house he wanted, a big one, and he hit redeem all. A few weeks later, we grabbed coffee at the Blue Bottle in Buckhead. He's still wearing his tailored Lululemon gear, but for that entire half hour, he's nervously stirring the ice in his oat milk latte. Clack, clack, clack against the plastic cup. Condensation drips down, soaking into his pants, a dark stain spreading. And Dave, a guy who normally cares deeply about his image, doesn't even notice. I ask about the house, casually. A muscle near his mouth twitches. He stares at the table, dry, rapid-fire tone, reaching for Wall Street jargon like a life raft. He reached for Wall Street jargon like a life raft. Bro, it's not a fund issue. It's just macro headwinds, Powell's rate hikes, temporary liquidity constraints. The underlying assets are still solid. You see, Wall Street's greatest trick isn't taking your money. It's giving the blade an elegant name. Liquidity event. Macro headwinds. When someone starts reaching for words like that to explain why they cannot access their own cash, you know something has already broken. He didn't cry. He didn't break down in front of me. To stay elegant above the surface, he was kicking, frantically, below it, until every last drop of oxygen was gone. I wanted to know exactly how much oxygen he had left. I watched him recite these advanced vocabulary words, almost like a script. Then I asked softly, "So, out of the $500,000 you tried to redeem for the house, how much did they approve?" His hand, stirring the ice, froze completely. 5 full seconds passed. He looked away, out the window, voice as small as a mosquito. 25,000. The fund had triggered the 5% redemption limit. He had $500,000 on paper, but this quarter, he could only get $25,000 out. The rest had to wait, quarter by quarter. He went quiet for a second. Then, almost to himself, he said something I didn't expect. I knew there was a liquidity clause in there. I read it. I just didn't think I'd ever actually need the money this soon. That's the part that stuck with me. Dave wasn't stupid. He wasn't careless. He'd read the same page 187 I had. He just made a bet that he'd never need the exit and lost it. I found out later, a real bank run was happening underneath it all. The smart institutional money had quietly pulled out long before. By the time Dave got in line, the 5% ceiling had already been triggered, and he had $500,000 in there. The system told him, this quarter, you get $25,000. The rest stays locked. Eventually, the fire couldn't be contained. The fund was forced into a fire sale. Dave's net asset value started dropping in a straight line, just like it had climbed. The building was on fire. The doors were locked. They were only cracking it open to let 5 people out at a time. And Dave was number 10,000 in line. Now, on the secondary black market, people are dumping shares at a 40% loss. But if Dave cuts his losses now, he won't even have enough left for his down payment. Maybe Dave just got unlucky with the timing. Maybe most people who buy into funds like this never run into this problem at all. They hold, the music never stops, and the curve just keeps climbing. But that's not really the point. Risk isn't measured by what happens most of the time. Risk is measured by what happens on the day you actually need your money. And you never get to pick when that day arrives. That day arrived last July. For me, that day arrived last July. Let's stretch the timeline, 3 years, and let's do the real accounting. Last July, the hottest, most suffocating month of the year in Atlanta. Monday, my supply chain company announces a 10% structural optimization, layoffs, panic spreads across the entire office floor. That same afternoon, the AC compressor in my old Civic dies completely. In 95-degree heat, the mechanic quotes me $2,500. At the exact same time, across town, Dave's SaaS company announces 15% layoffs. Dave, always so relaxed, always so easy, completely panics. He's carrying a massive mortgage, a Tesla lease with a huge monthly payment. On paper, he made vastly more money than I did, but that $500,000 he was so proud of, dead-bolted, inside a black box marked gated. He couldn't touch it in an emergency. He was actually losing money, working odd gigs just to keep up the facade. What he was left with was a few months of early distributions, a delayed redemption queue, and shares he could only dump at a painful discount if he wanted immediate cash. My money wasn't gated. 6 p.m. I'm sitting in that same sauna of a car, AC still broken. Mechanic's bill in one hand, layoff notice on my phone in the other, and for the first time in a long time, I didn't feel like the loser. I calmly opened my Vanguard app, selected the SPY shares I'd been dollar cost averaging into for 3 straight years, typed in $3,000, hit sell, no queue, no 5% ceiling, no fund manager's attitude to deal with. The screen instantly read, trade executed, cash deposited directly into my checking account within 2 days. In that moment, watching the sun set through my windshield, shirt clinging to me with sweat, nothing dramatic happened. No revelation, no fireworks. I just realized I could solve my problem immediately. That was it. That was the whole feeling. And somewhere in that quiet, I understood something about all those years of awkwardness, the loneliness, the self-doubt, that sting at the dinner table, not fitting in. It wasn't because I was stupid. It was simply the price I was paying for something incredibly expensive, the freedom to have absolute control over my own life, anywhere, anytime. Wall Street loves to teach you to let your money work for you. But here's what they'll never tell you. The most important job your money has isn't generating fake interest on a piece of paper. It's the ability to instantly turn into a shield, to buy back your dignity the moment life pushes you into a corner. Liquidity might not pay interest, but it's the most expensive oxygen in the world. And on Wall Street, when you actually need oxygen, it costs more than gold. The reason someone's willing to draw you a flawless, unmoving straight line, it's because they've already confiscated your oxygen tank. Nobody confiscates your oxygen tank without a reason. Here's the reasoning, laid out plainly. 3 years have passed now, Dave's still wealthy. On paper, my Civic's still battered. But in the ultimate brutal stress test that is real life, I want to leave you with 3 counterintuitive truths. First, that accredited investor status you can't qualify for, it's not a VIP card, it's a liability waiver. Most people see that $1 million net worth requirement, that high income threshold, and think it's a golden ticket into the rich man's club. But under SEC rules, the real subtext is this. You're rich enough to survive even if you lose everything. So we're revoking your retail investor protections. In this game, you're not a VIP. You're a legally sanctioned, unprotected lamb, waiting in line. Second, and this one explains everything else. The financial world obeys the law of conservation of energy. No exceptions. If it's an asset, it carries risk. Period. So when you see a perfectly flat yield curve, zero volatility, smooth as glass, that doesn't mean the risk vanished. It means the risk got moved somewhere you can't see, usually into liquidity. That high interest paid out right on schedule every month, it's not a reward for being smart. It's compensation for voluntarily welding shut your own escape hatch. And last, the one Dave learned the hard way. Never expose your oxygen tank and your rice bowl to the same risk. When the macroeconomy cracks, corporate layoffs and institutional bank runs tend to happen at the exact same time. The moment you desperately need cash to survive is often the exact moment the fund locks its doors. The entire purpose of an emergency fund isn't to beat inflation. It's the ability to turn into real cash in your checking account on the very afternoon a crisis hits. That crisis afternoon never came for Dave. The money just sat there, useless. The reason someone's willing to draw you a flawless, unmoving straight line is because they've already confiscated your oxygen tank. Pause. Look into the lens. Freedom has a price. Sometimes that price is enduring the volatility on your ledger and the lonely feeling that maybe, just maybe, you're the loser in the room. But as long as you're still holding your own oxygen tank, you'll always have the right to walk away from the table. If this resonated with you, if you'd rather hold on to real freedom than trade your ultimate leverage for paper interest, consider subscribing. I'm Ben Finance. I'll see you in the next video where we keep settling the real accounts. See ya.